Good morning and welcome to Marcus&Millichap's 2012 Retail Real Estate Investment Market Outlook. I'm Bill Rose. I lead the firm's national retail group, an advisory of nearly 300 real estate professionals focused on retail property investments and finance. I'm joined today by my partners Hessam Nadji, our head of research, and Bill Hughes, our capital markets chief. You likely noticed that we have a live streaming video format. We hope this new talking heads provides you with a better content, guidance, and insight. As always, we encourage you to submit questions through your web browser during the broadcast. Should your screen freeze, hit F5. That will refresh it. To that end, let's turn to Hessam Nadji for perspective on the economy. Hessam?
Thanks, Bill. Good morning, everybody. It's a pleasure to be part of the program again. My job today is to talk about the economy and where it's headed for 2012 and relate that to retail supply and demand fundamentals. So to begin with, let's get the macro issues on the table. We're still mired in uncertainty regarding the European zone crisis, debt crisis. We're still facing a number of challenges with the U.S. residential housing market. And, of course, the U.S. political logjam hasn't helped get the level of uncertainty in the marketplace reduced. But while these macro-level headwinds are serious and they have caused a lot of volatility in the marketplace, there are a number of positive indicators that give us some hope that the recovery will continue into 2012. I want to start out by talking about how this economy is really transitioning, having come out of the recession with some positive momentum after a lot of government initiatives were taken, and posting some good numbers late 2010, early 2011, and then losing steam again. Of course, in August, when the U.S. debt was downgraded, concerns really were much, much higher regarding another recession, coupled with the problems with debt in Europe. There was a lot of fear that the U.S. would re-enter another recession. The evidence that we've seen over the past 2 or 3 months suggests that is not the case. Our position a few months back was that we're likely in a stagnation mode, and we're likely to stay there for a while. But because of a number of points of strength in the economy, the chances of a recession were quite low, and so far the data has proven that out. So if you look at your graph, you're looking at the U.S. GDP numbers, which have lost momentum substantially, but the third quarter numbers came in, that's the most recent reading, much higher than expectation, 2.5%, which confirms the fact that U.S. is still in a recovery mode, but at a very, very low pace. Going forward into 2012, we expect some momentum to pick up, but overall, the recovery is going to lag the traditional pent-up demand, release of pent-up demand that you would see after a significant recession. One of the major headwinds that I talked about was the U.S. housing market, and of course, we're continuing to see problems with the for-sale housing. There's 2 or 3 waves of foreclosures still coming through the system, and it is not going to be until 2013 until we see a sustainable and ground-up recovery in the housing market. This is important because it weighs heavily on the consumer, both directly in consumer finances and psychologically. At the same time, the job picture is very much mixed. On the positive side of the ledger, we've seen the last 2-3 month readings get revised upward. Even since August, when the U.S. debt downgrade hit the headlines and increased the level of fear for a recession, we did not see a panic among companies, and they continued to add jobs. We've added over 100,000 jobs a month on the private sector side, and another piece of good news is that instead of relying so heavily on temporary employment, companies are relying more on permanent employment, which is a trend that is shown on the left side of your screen. However, again, we lack a lot of momentum. We're in a positive territory, which is encouraging, but the kind of momentum you would expect at this time coming out of a major recession is just simply not there. It is unlikely to emerge anytime soon. So as retail owners and investors, we have to be prepared to slug it out for at least another 9 to 12 months until some of these clouds that are holding back the economy maybe begin to fade away. And Europe does play an important role because if you look at our exports, Europe accounts for 18% of our exports, and exports have been an important part of this recovery. And if Europe goes into recession, we do have a pretty direct correlation and impact to the U.S. economy. So we have to watch that very carefully. Now, for some good news, especially as it relates to the retail real estate industry, retail sales in the U.S., which experienced an unprecedented drop during the Great Recession, as you can see on the left side of your graph, have not only recovered from that significant drop, we've also seen an increase to the level where we're 6% ahead of where we were prior to the recession. So the 2007 peak in retail spending has now been exceeded by 6%. That gives the economy a very strong footing because retail sales account for 70% of our GDP. And given this stronger footing, we get confidence that we're not entering into a recession, although expecting those kind of numbers from the consumer going forward is going to be unrealistic because of high unemployment and my comments regarding the for-sale housing market. Another important indicator which gives us some confidence that this recovery will continue is the broad-based nature of the job creation we've seen so far. First of all, it should be noted that in the last 12 months, the private sector added 1.8 million jobs. That is a disappointing number in many ways, but it still accounts for enough job creation to create demand for commercial real estate, including retail. And if you look at this graph, you can see that professional and business services added 560,000 jobs, education and healthcare over 400,000 jobs, trade and transportation, which affects the industrial market, of course, over 300,000 jobs, and even manufacturing added 200,000 jobs. Leisure and hospitality added over 200,000 jobs. So this was a very broad-based creation of jobs, and that gives us additional hope that there is enough strength for the recovery to continue. As you can see on the slide, of course, government jobs are in the negative territory by a very large number, over 300,000 jobs, and that's dominated by local and state municipalities that are still in a very, very poor condition financially. So if we add all this up for an outlook for 2012, of course, the most important reading is job growth. I'm showing you here on this graph this particular cycle compared to some recent recessions and comparable recessions in the mid-70s and early 80s, where back then we had significant job losses followed by significant, way above average job growth. You can see on the dotted line where the long-term average is. And unlike those recessions, and I chose those because they had some similarities to this last cycle, the early 70s was really driven by the global oil crisis, and the early 80s was credit-related. So I thought there would be good points of a comparison. Unlike those periods, we're not expecting a release of huge pent-up demand or a V-shaped recovery because of the headwinds that I talked about at the outset of the presentation. So we go from significant job losses, 8.5 million, just going back to average job losses. But even then, that'll translate to 1.7 million jobs in 2011, followed by 2.2 million in 2012. Again, very disappointing, but I believe realistic enough and strong enough to support the recovery in commercial real estate, including retail. And one of the most important aspects of retail investing is the composition of retail sales, composition of the tenant mix, and so on. And technology is bringing about a lot of change in our industry. The fastest growing segment of retail sales is online sales, as you can see from this graph. And it has had a direct impact, not only on local, smaller retailers, but even larger retailers like Best Buy, that became pretty much a category killer when Circuit City went under. But even then, with that advantage, online sales really pressured Best Buy's profitability over the past 12 to 18 months, and they've really struggled to reposition themselves. So online sales are a significant and sustainable force in the marketplace that retailers have to account for, as do retail investors. However, because of the top-line strength that I talked about, because of the stronger footing that I talked about for the U.S. economy, and the top-line retail sales that we discussed earlier now being way above, or well above anyway, pre-recession highs, the in-store retail sales are also increasing, as you can see from this graph shown on the red line, at a very healthy pace. This is now translating to pretty robust levels of retail absorption, net absorption of retail space. which is exactly what we need to see for a recovery in retail to have conviction. So as you can see from the graph, this particular analysis goes through mid-2011. There was a very tight correlation with in-store retail sale improvement along with net absorption. In fact, if you look at the quarterly analysis of net absorption, you can see that we've seen a positive trend for 7 quarters in retail. The numbers are not strong enough to cause an exciting recovery. Certainly, you can look at the trend line here, and the absolute square footage of net absorption is still disappointing and lags prior periods of strength. But once again, we really have to take a look at the sustainability of the recovery. And even though the numbers are disappointing, they're still in the positive territory, and we expect them to stay so. A longer-term viewpoint on retail, I think, points out one of the most important factors we have to keep in mind over the next 2-3 years, especially as it relates to appetite for risk, and that is the reduction of speculative construction. If you take a look at this graph, which goes back to 1985, we have not seen this level of drop in starts and speculative retail development during that entire period. And that is another very important factor that is going to help us sustain the recovery that we're in. Another important factor is to differentiate between the types of retail that are experiencing more pain than others. As I've spoken on these presentations before, the vast majority of the problems are concentrated in newer centers that were built in relation to rooftops that were going up way ahead of sustainable housing demand. And you can see the vacancy rates by age reflect that. The good news is that the newer centers that came online are starting to show some recovery. But if you remove that from the marketplace, the overall health of established infill retail is evident on this graph. Our investor audience always asks for market rankings and commentary on different metros. Because the macro recovery is somewhat muted, it becomes very important to go into a more micro strategy, and market selection becomes very, very important. There is no surprises on this chart. You can see the low vacancy markets on the left and the high vacancy markets on the right, but there are a couple of key trends that would be good to note. One, of course, is the supply-constrained nature of the low vacancy markets: San Francisco, San Diego, Washington, D.C., San Jose, Seattle, Boston, L.A., Orange County, and the East Bay in the San Francisco Bay Area, all very supply-constrained, low vacancy markets. And if you notice on the graph, continuing to show drop in vacancy, whereas some of the markets on the right side of the ledger, which are there for a combination of either weak economic drivers or the housing crisis, having had an acute level of problems with for-sale housing, are not showing as much recovery quite yet. So Cincinnati, Phoenix, Dallas, Cleveland, Las Vegas, Atlanta, Detroit are examples of those markets that fall into one of those two categories, and we're still not quite seeing the recovery yet. So the stronger markets seem to be getting stronger. The hard-hit markets haven't quite entered recovery yet. But this graph, I think, gives a roadmap of perhaps an opportunistic investment strategy, or, depending on your appetite, more of a flight to safety strategy, which has been dominating the market over the past 12 to 18 months. So with that, I'll turn the presentation back over to Bill Rose. Bill?
Hessam, thank you. Your last chart noted Dallas-Fort Worth, Houston as high vacancy markets, which seems a little contrary given that Texas is one of the more stronger, favorable economies in the country today. What's in the details?
Well, I think the most important thing about the recovery and recovery markets is the pace of job growth versus their tendency to overbuild. Texas, as we all know, has had a tendency to overbuild, but it is at a very unusual point of the cycle in that the construction pipeline is quite light in Texas, which doesn't happen very often, and the economy is really getting traction. In fact, most of the Texas metros would be among the top 10 job creators around the country. Dallas and Houston were, I think, number 1 and number 2 over the past 12 months in job creation. So your point is a very good one in that they're entering this economic recovery way ahead of most metros, but they had so much overbuilding going into it that they still have very high vacancies. Now, over the next 2 or 3 years, I think they'll be among the stars in terms of vacancy drops, effective rent growth, and so on and so forth. The question is, will they start to overbuild fairly quickly once that recovery happens, as they traditionally have done? Phoenix, to some degree Atlanta, to a lesser extent Atlanta, and certainly Florida are in a similar kind of a pattern. Those markets tend to outgrow because of demographics and jobs. But the next 2 or 3 years are going to look very good for those markets.
Good. So keep your eye on the Lone Star State. Bill Hughes, welcome. You're a veteran capital market participant. Did you ever think you'd be working in a sub-2 treasury market?
Well, I would say not in my lifetime. In my lifespan, a few years. So, I have a lot of history behind that, and there's a lot into that result. Obviously, a lot of kind of bad information that's caused a lot of fear in the marketplace, and I think that we're going to continue to see that certainly for the next few months as Europe works through their issues, and we saw it today with market moving around a little bit. Right. So I think that's going to continue for a while.
Good. Well, tell us what to expect in the capital markets for 2012.
Thanks, Bill. Well, I don't think it comes to anyone's great surprise that these low interest rates have been a real driver to the commercial real estate market. Certainly, they've enticed investors who might otherwise be sitting on the sideline back into the marketplace. They've certainly improved cash flows, and cash returns have been improved substantially. And I think, lastly, values have been influenced in a very positive way as we've moved through this marketplace. And that's all as a result of these, historically low interest rates that Bill was referring to just a few seconds ago. I think that lenders, we want to talk about them for a little bit. They have been pretty stable over the last 6 months in hindsight. Not much changed really over the entire year. Deals, lenders are primarily looking for consistency and quality of income stream. Certainly those centers, best of class to B quality assets, centers that are necessity centers, if you will, are really the centers that lenders are looking to finance in today's market. On the other side, and it's have and have not. The have not to that side is that smaller centers in smaller markets, tertiary markets, that's a very choppy environment, and certainly it's a challenge to find lenders that are traditionally in that business. In terms of underwriting, what we've seen over the last 6 months, really not a lot of change there. I think once again, same kind of thing. We're looking for stability of income stream. We're looking for strong retail sales. I think that that's just sort of what the market is and what the market will continue to be. Best of class centers certainly in those financings. Debt yields 9 to 11%. Some lenders are still using those debt yields. Many lenders have just gone back to the standard debt service coverage at 1.3 to 1, and that is going to produce a loan to value of 60 to 70% in today's market, certainly. The good news about the market is that over the last 6 months, we've clearly expanded capital sources into the marketplace. Life insurance companies, CMBS we'll talk about, commercial banks, a big player in the marketplace, and debt funds have participated in a much more aggressive way as we have moved through the market. So we're talking a little bit about interest rates. Let's move to interest rates, if we will. And obviously, there's some fluctuation going on in the marketplace right now. While core inflation is really right at its 10-year average, you're looking at the 10-year, which is more than a couple hundred basis points lower than its 10-year average. And certainly with what's happened in the last few days, I woke up yesterday morning, the 10-year was at 202. It moved during the day up to about 210. It fell back down, closed at 201 yesterday. And as of just a few minutes ago, we were looking at it, it was 196. If you look at starting June, the far right side of this slide, you'll see that that's really when the market started to change. European debt crisis is impacted. Obviously, our inability to deal with our own deficit spending and debt load and extension caused a lot of that fear to enter the marketplace, and we saw the 10-year Treasury go certainly south in a pretty meaningful way. Let's take a minute to look at who are the participants. Obviously, if you look from 2009 to 2010, significant participation by commercial banks, CMBS lenders, and life insurance companies. What you might note here from 2009 to 2011, the CMBS marketplace has grown significantly at 34% this last year. And that's a concern because we need full participation by these lenders as we move forward, and we'll talk about that in a minute. The big player, obviously, on this block are commercial banks who have participated. Large money-centered banks, to a large extent, have created and have participated quite broadly in servicing the retail sector, certainly. Commercial delinquency rates. I think that third quarter delinquency for CMBS, it depends on which service you're looking at, but rose to 9.77% in October. I know this only goes through the second quarter of the year, so it's obviously increased a little bit. We had a couple of months there where it fell down. From July, it was 9.88. It's pushed up, and so it's fluctuating a little bit in the marketplace. And that's what we expect to see moving forward. In terms of retail as a part of that number, 6 months ago, I should say in October, retail delinquency was at 7.61%. 6 months ago, it was higher, 8.15%. A year ago, it was 7.17%. So it was better, got a little bit worse. It's come back to earth, and we continue to see that improve over the next certainly 6 months. Banks and thrifts, certainly October 441, in the second quarter of 2010, it's 441. It moved to 393 in October, so certainly some improvement there. And when we talk about life insurance companies, it is really so low that it's almost meaningless, less than 0.5%, and that's a really positive thing as we move through the market. So we talked a little bit about some of the why I was concerned about participation. This is really why of all those four food groups, if you will. 2011 through 2015, we have 1.77 billion of loans maturing in this country. A majority of that are with commercial banks. We believe that many of the banks are well prepared to participate at large levels as their balance sheets have been healed. They are making money. They are moving forward. But you can see here that there's some pretty big numbers. CMBS moves from 53.5 billion to 62.5 billion. Banks moved from 204.5 billion to 210.4 billion in 2013. Life companies 23.6 to 24.4 billion in 2013, and other 66.5 to 74.4 billion as we move through this large chunk of loans that are going to be maturing. Now, the reason why that healthy participation of these four food groups is important, particularly CMBS and debt funds, is because of this slide. Over the same period of time, 1.77 trillion of debt maturing, you have 1.06 trillion that is underwater. Underwater meaning that the debt load is more than 100% of the value. So obviously, we have significant amount of deals underwater. That represents 69%. Almost 70% of the loans that are maturing are underwater. The good news is that if you look at 2011, we're about through the year, about 50% of that debt, a little less than 50% of that debt was underwater. We've been able to work through that, and hasn't caused a lot of angst in the marketplace, although certainly we have seen some increase in distressed assets hit the marketplace. We have seen some discounted note sales more go on this year than in the past, but done in a very orderly fashion. Now here's the key, CMBS, and this is the concern I have moving forward. 2010, we did 11 billion in CMBS debt. This year, we've done $27.2 billion. There's a transaction that was priced last week, RBS. I forgot who the other participant was. I apologize.
Wells Fargo.
Wells Fargo. RBS Wells Fargo participated. Thank you, Bill. But $1.1 billion. We believe that by the end of this year, we will have done probably 30 to 32 billion. That is far short of what everyone is anticipating earlier in the year with a 35 to 50 billion dollar market. We need a full participation by the CMBS lenders to be able to resolve all that maturing debt that we've talked about over the next few years. The reason that CMBS has sort of fallen short in the second half this year, if you look at this slide and what's happened over certainly the last 6 months ago, 10-year AAAs were 179 on July 8th. They soared to 339 on October 7th before receding to 283 by the end of the month. Now, they've improved a little bit. That transaction with RBS Wells was priced last week. All indications are that those spreads came in some. That is very positive for what's going to happen in the future. But all that spread widening is because of all the uncertainty in the marketplace. European debt crisis, choppy domestic economy, the economy's inability to develop employment opportunities, concerns over domestic debt, consumer confidence. It's all waned and has impacted the secondary market, and secondary markets investors' willingness to take on risk and move forward with risk and spreads. We're starting to see some improvement there, but it continues to be a concern and will be. So if we can, let's look at investor concerns and outlook for 2012. We've just talked about what's happening with a choppy domestic economy and the global influences. But with that, we believe that what we've seen in the last 6 months will continue into 2012, certainly. We think that the marketplace will be pretty stable because of really that. And we think that rates will be range-bound and won't move a whole lot. We'll see some choppiness, just as we talked about this morning, with the 10-year Treasury moving up and down 10, 15 basis points. I think that we'll continue to see that. We've got an election next year. A lot of things are going to impact where rates go, but I think all in all, it's going to be relatively stable. Capital supply should remain healthy, but not for every asset, as we've spoken about before. Obviously, the best of class, B quality, drug, grocery-anchored retail centers, those centers that really are needed, tenants that are necessity-based tenants are going to do better. Major MSAs, certainly gateway cities, NFL-type cities, we're going to finance those more readily and more easily than we would in smaller tertiary markets. Strip retail, you're going to have a problem. But there are lenders for those. The cost widens, the cost increases. It's just going to be a little bit more challenging moving forward. Capital supply in terms of life insurance company, regional and local banks, very important to the retail sector. Debt funds and CMBS. Debt funds and CMBS are going to be particularly important because they allow us to finance higher in the capital stack. With CMBS, we can finance 70, 75%. Most of our traditional lenders, 60 to 65%. When we talk about debt funds, certainly we can move up the capital stack into mezz and preferred equity, actually up in some instances to 90% with the right transaction. We need those debt funds, and they are more active than they've ever been, certainly in the last 3 years, and that's a positive for us. So let's talk about investor strategies, if you will. Hey, I've got a loan, it's maturing, I'm underwater, what do I do? Well, there's two really options for a client. One is to talk with a lender about extension, and the other is to recapitalization. They aren't exclusive to one another by any means. Certainly, we're going to be throwing some new capital at some of these properties. We're going to be going to debt funds and financing up some of these properties to be able to pay them off. The other option, of course, is that we can extend. Now, the key to extension is if your property value is pretty close or greater than the current loan balance, the lender's going to be less willing to extend for you. They're going to be more willing to take the property back. They're going to be more willing to push it into the marketplace and recoup their investment in that property. You have to understand that. You have to take strides and take a position to work around that with recapitalization or looking at the capital stack in a whole different way. I want to talk about refinance if we can for a quick second. Say your investor $1 to $10 million. Certainly that investor is looking at typically recourse financing, very limited non-recourse financing with some of the smaller life insurance companies, but typically those properties are financed with local and regional banks. As I said, some smaller life insurance companies, and you probably don't have access to debt funds or CMBS at that level, maybe at the $5 million and up level, typically 70% financing. Typically your rates are going to be somewhere between 5.5% for 10-year financing up to about 6.25% for that kind of product. If you're in the 10 to 20 million, obviously the number of lenders that you can access are greater. Certainly CMBS, life insurance companies, commercial banks, and you're starting to access debt funds to be able to go up the capital stack. Same thing, recourse, non-recourse, a little bit more non-recourse debt available to you, and you're probably 25 basis points under what we were talking about with some of the smaller loans. Then when you get to $20 million, whole different game, really. You have access to the entire source of lenders in the marketplace, finance up the entire capital stack. We've even seen some life insurance companies move into the marketplace with 10-year financing, certainly in the low fours. We've recently done a 5-year deal, 50% financing under 4, and that's the type of financing that's available for you in the marketplace. And we've delivered a lot of that product. So hopefully that gives you a pretty good perspective of what's going on in the marketplace today, what we look at over the next 6 months. We think that we're going to continue to finance in a marketplace pretty similar to where we are today. So, Bill?
Boy, if it tells me anything, we've got to stay in touch with your group to know where capital's flowing. Back in 2009, we had this big mounting wave of pending distress. But like the Grinch that stole Christmas, there was only a whimper. What happened to all this distress debt, Bill?
Well, I think there's some of it still there. I mean, obviously, if you look at the maturities, starting in the beginning of this year, 1.77 trillion maturities coming to the marketplace. A lot of them are underwater. But I think lenders have been very patient. They certainly learned from the RTC days. They know that the markets are coming back. The economy, while choppy and all the stuff that Hessam spoke to, they appear to be sort of stabilizing, at least maybe from an optimistic standpoint. Lenders aren't willing to give that up as easily as they were in the past. And I think that their balance sheets are starting to heal. They're starting to do a little bit better. I think there have been some large note sales at discounts, although the discounts haven't been as significant as what we thought they were going to be. We just don't see a lot of that distressed product hitting the marketplace. I think we also have, with the advent of debt funds increasing substantially over the last 8 months or so, the number of debt funds in the marketplace, I think we're going to be able to take on a lot of that troubled debt, because we're going to be able to finance at a higher level. Investors are going to be able to recapitalize that debt and move on to a better day.
The other aspect to keep in mind, especially when it comes to investor expectations of fire sales on quality assets, is that this cycle was so different than what we experienced in the early 90s, in that in the early 90s we were not at the brink of a severe systemic shutdown as we were this time around. Therefore, back then, lenders could afford to basically get rid of distressed assets in the form of the RTC, which didn't really exist this time around, and it's very unlikely to emerge again. And because of the fact that there was systemic risk, the lenders really had to avoid fire sales, and it's a strategy that appears to have paid off.
Sounds like we're moving all of that legacy debt through the system in a managed way.
Yeah.
And it shouldn't be a great concern moving forward through the maturities that you saw in 2015. Well, let's now look where pricing and cap rates are in the investment opportunities we have in the retail sector. One can see we're fast approaching transaction volume nearly half of the 2007 peak. Look there, the yellow bar, those are deals in the $20+ million range. The red is the $10 to $20 million range. That's the tweener category. And the blue is everything below $10 million. At first blush, it looks as though that the significant volume is occurring in the $10 million range, which does reflect the re-engagement of institutional activity. Recall, though, that these metrics include the $9.4 billion Blackstone Centro recapitalization of some 600 properties in the second quarter. Now, take that out of the equation, and the industry is still 25% ahead of third quarter 2010. But that's not the whole story. Take a look now at larger deal velocity. While it is a significant portion of the volume of the business, it's certainly not the portion of the transactions. On average, 87% of all deals closed over the past 10 years were below $10 million, which in the retail space typically represents single-tenant net leased activity. Throughout the capital market freeze of 08 and 09, 92% of these trades were sub $10 million. This trend will continue into 2012 as the private sector demonstrates that there is no lack of interest or equity to acquire retail real estate. Expect deal volume to probably exceed $51 billion on over 10,000 trades next year. Here's a great slide. This is a more illustrative picture of deal volume by product type. To the left, the single tenant. To the right, the multi-tenant. Clearly, retail investment trough is in the rearview mirror, and the market continues to grow on 10 consecutive quarters of favorable trading volume. See on the multi-tenant side, there's a spike there in the second quarter. Again, that's the Blackstone Centro recap. It is reflective also of the restart of CMBS that Bill Hughes noted. To maintain a steep V curve, we do need to see CMBS continue to grow. Pundits have teased that we're moving on to CMBS 3.0. But given the success of that recent Wells UBS securitization last week, which I did want to note that's predominantly made up of 75 fixed-rate loans secured by 98 properties. These are primarily devoted to the retail sector. So in the CMBS space for retail, at least, I think it's a favorable outlook. Let's take a look where these deals are pricing. The net lease space is represented in the charts on the left, multi-tenant to the right. Both product types are experiencing cap rate compression due to historic low interest rates, as well as a flood of pension fund capital chasing core. Several deals in the net lease space circled in the sub-6, and in the multi-tenant space, shopping centers have closed in the low 5 range in certain high barrier entry markets of Southern California, low 6s in Chicago, D.C., and New York MSAs. Expect compression to continue in high barrier entry markets as supply of quality net leased Walgreens, CVS, Wells Fargo type deals are constrained, and that of necessity-based retail, the grocery drug type product, in the multi-tenant space. Certainly this flight to quality demonstrates commercial real estate's favored status over current equity and bond markets. Repricing of risk. This is a great slide. It shows in the tertiary markets in the red, the green are the secondary, the blue is the primary. Over the past 36 months, spreads between these markets has widened out in 100 basis point intervals. I anticipate these spreads coming in. If you really know your game, a going-in cap in these markets are likely to deliver mid-teen yields many investors are seeking. If a center's tenant mix demonstrates strong historic fundamentals, the market's going to reward you over time. Let's look at the cap rate trends. What's driving the compression? Bill Hughes said it. It's the 2-year Treasury. This is only the second time in our experience the 10-year went sub-2. As Hessam noted, the Greek debt woes, European, et cetera. I think we've beaten that to a pulp, but it's certainly true. Investors are fleeing to the U.S. Treasury as a safe haven. And I don't know what S&P was thinking, but clearly market opinion is voting on the 10-year Treasury. The symbiotic relationship between debt and equity remains true. Monitor the 10-year. As the 10-year goes, so do cap rates. So who's buying? If we look at this chart, we've got the blue is the private sector, the yellow are the REITs, the orange is the institutions, the gray are the equity funds, the orange down below is the foreign investor, and then the balance there is in the green. Well, let me tell you, Teachers and AGP, which is a Netherlands-based pension fund, they recently allocated $1.1 billion in a 5 regional mall joint venture with CBL. while Inland led the REIT pack with nearly $300 million in large property transactions. The equity fund category, this is appropriately identified in gray, is dominated by Blackstone, and again, the $9.4 billion recap of Centro. But stay tuned. Blackstone is soon to close a $473 million acquisition of 36 property portfolio located in Atlanta, Tampa, and Orlando. Let's take a look at the valuation indices. This is benchmarked to the S&P 500. The S&P there in green, the retail REITs in green. In the red are all REITs and, of course, the S&P 500. The S&P 500 significantly below what retail REITs are returning. This is a great snapshot noting retail strength compared to the S&P. This is really no surprise given the current financial health of retailers making up the bulk of the income in these REITs, those being Walmart, Target, etc. All of these retailers are BBB rated and better, and are certainly demonstrating investors' belief and confidence in those type of retailers. So let's look at the distressed trends that are in the market. Don't confuse all of this very positive dialogue as a coming bull market. Rather, note the enthusiasm is to be tempered by the fact that there's still $1.7 trillion of commercial real estate debt maturing through 2015, as Bill noted. We do have some issues to overcome, but I like to focus on the red line there, which notes that there's a significant improvement of delinquencies and that legacy debt is efficiently moving through the system. Let's now look at the 2012 forecast. Commercial real estate to provide better risk-adjusted returns compared to the markets. This certainly indicates a very strong vibe for commercial real estate. As noted, the equity markets and the bond markets are not nearly returning the same values that commercial real estate is. Core assets, this is certainly going to push a high watermark. In the market today, we see a lot of deals trading, as noted. That's going to continue. There's a very strong interest in these core markets. Midsection to see increased deal velocity. That is these markets in the middle of the country, the Chicagos, the Houstons. These are very strong NFL-type cities. They're rock solid. They continue to demonstrate consistent real estate fundamentals and are currently posting favorable going-in cap rates. The pension funds, they're going to continue to aggressively pursue commercial real estate, but monitor those equity and bond markets. As those adjust, so will the pension funds' balance sheets, and they might carve back their allocations to commercial real estate. Private investment growth is contingent upon CMBS really kicking in, as Bill noted before. So those are my highlights for 2012. Why don't we now open up to a little Q&A that Hessam has been monitoring from you all in the marketplace.
Thanks, Bill. We have been receiving a lot of questions from the audience throughout the presentation, which I've been noting. One of the things I wanted to take a moment to emphasize before we get into the actual questions from the audience members is on the graph that you showed, Bill, that explained the difference of the spread between the 10-year Treasury and retail cap rates. Very interesting. If you look back in time, going back to the early 90s, any time that the spread was nearly as wide as it is today, and today the spread is as wide as it's been since that time period, it really signaled a great buying opportunity. 1992, 1998, and 2002 in particular. Do you buy into that? When you look at that graph and really examine the spread, does it tell you that it's a great buying opportunity?
I think in my 25 plus years in this industry, this is the most significant buying opportunity we've seen. Several reasons. One, the treasuries. Nobody's seen it. It's a pretty good time to be investing given your cost of capital. Number two, and most importantly, those tenants who make up the income on these properties, really well heeled. The Walgreens, the Targets, the Safeways, Kroger, Chase, Wells Fargo, Walmart. These are the top retailers in the country. Look at their balance sheets. Really healthy. Their inventories are firm, not bloated as they were in the past. I think it sustains for really nice growth. Not vertical growth, really nice consistent growth.
What about the pressure on other tenants, Bill? The smaller local tenants, regional tenants, they've struggled. And as we've seen, job growth among small companies still hasn't really kicked in yet, which speaks to that local, if you will, small retailer. What's your outlook on that?
As I monitor the top retailers in the country, the ones mentioned, yes, they are very healthy. Some of the smaller, perhaps it's the franchise operator of the sandwich shop or the nail shop or the salon. You do need to be careful when you're looking at a retail investment. Study those deals deeply. Drill into the details. Make certain that their occupancy costs are in line with their sales. And interview those tenants as you're looking to buy an asset. But certainly, in certain markets, if you do see too many sandwich shops, you ought to be cautious about that.
Bill, we received a lot of questions regarding the outlook for interest rates. Everybody's aware that interest rates are a huge driver of today's investment marketplace, with the notion that if you lock in the interest rate ahead of the economic improvement, eventually it should come, and eventual rent growth, that should be a winning strategy. Your graph showed core inflation rising, the 10-year yield coming down, very unusual intersection of those two lines. Does that mean that once the problems with Europe are at least maybe not solved, but reduced as a threat, and we get through the elections and a little more political certainty here in the U.S., and the economy starts moving again, as those fear factors get removed from the marketplace, are you expecting to see interest rates move up rapidly, or do you think we'll see moderate interest rates over the next few years?
Well, I think it literally is a little bit like a rubber band that's been stretched, and somebody's going to let it go at one point in time, and you're going to see it snap, and we're going to see a fairly good jump in interest rates. But I think, the consumer right now is pretty weary. I think, employment is so choppy. I think we have these global concerns, global economies that impact what goes on. We don't buy a lot of our own, actually, treasuries. Foreign investors buy our treasuries as sort of the safe haven and the gold standard, and that's what's happening to pricing on treasuries. Clearly, there's always been a correlation between core inflation and the pricing on bonds. So as core inflation goes up, so should treasuries, and they eventually will. I just think that there's, as you noted, there's this fear factor in the marketplace. Certainly, and the government has subsidized with, whether you call it Operation Twist today or QE1 or QE2, right, has sort of kept rates down to a measurable level, and they've already stated that they're going to try to do that until 2013. But with that said, we saw yesterday there was some good news about Europe initially. We saw the Treasury move out, and then we saw some comments about Italy this morning, and we saw the Treasury fall back down. So I think it's erratic right now, but over the next 6 months, certainly there's pressure on interest rates to go up. And if you look out into 2013, when hopefully this economy takes some real steps forward in terms of employment growth, consumer confidence starts to come back, I think we're going to see some good jump in interest rate. Now, what does that mean? I'm not saying it's going to jump overnight 100 basis points or 200 basis points, but you're going to see some consistent increase in particularly longer-term rates. It has to happen.
Great. Thanks, Bill. A lot of you have been asking questions about the effect of online sales. We talked about that in my segment of the presentation. Bill, this question goes to you. To what kinds of tenants are you seeing that are under pressure because of online sales? And how should investors take that into account when they're looking at investing in a shopping center?
Really great question. So eBay, Amazon, those are the top two providers of electronic retail sales. They are certainly growing, as you noted, but when you compare them to the overall bulk of retailers, they don't represent a big number. What they are delivering are books, electronics, toys, that type of product. So if we think of those retailers, Borders, they're gone. Yeah. But what's great about that is many of those boxes that Borders occupied, those are backfilling pretty quickly. Kohl's has been moving very rapidly in the market to take some of these spaces in many markets. So yes, it's a concern. Anytime that you look at a large shopping center with big box space, you start to think about residual value. Who will replace that? Circuit City. Well, Best Buy took that spot. Now, Best Buy is being smart. They are downsizing to about 18,000 square feet, and they are subleasing space within space to users that are more live, work, play, lifestyle oriented. Because at the end of the day, we all don't want to sit there typing for our goods. We want to go out and see you and say hi to your family as we shop through the marketplace.
Great. Thanks, Bill. The next question has to do with recourse versus non-recourse and the health of the commercial banks. We have a lot of private investors in the audience, of course, that are very concerned about their ability to secure financing. So, Bill, can you comment with a little bit more detail on how you see the commercial bank segment of lending play out over the next 12 months?
Well, I will first go back and say that ultimately, Hessam, when we first saw commercial banks come into the industry, we saw the local and regional banks come in first. It wasn't up until about 6 months ago, maybe a little longer than that, that we saw big national banks, big money center banks come into the marketplace, and they've certainly have dominated the banking industry over a period of time. I think they have a full plethora of really products they're selling now, sort of short-term to longer-term. We've even seen some construction finance, very limited, but certainly we've seen that happen for good quality properties, typically not in the retail sector, however, mostly in the multifamily sector. But, yeah, commercial banks, by the nature of the beast, their cost of funds are short terms. They want a loan short term, and they typically want some form of guarantee. We have seen some of the commercial banks fall off of the guarantees and the recourse with lower leverage debt, and that's sort of in play today. We've seen some interest-only deals, lower cost debt, and the reality is that there isn't one size fits all. It's dependent upon the quality of the asset, certainly the strength of the borrower, his or her relationship with the bank, certainly, and a lot of factors come into play. The marketplace, where the bank's located, but banks are engaged, and we need them to be engaged, and we need their engagement actually to grow into 2012 and 2013 because of the amount of debt we're going to be refinancing over that period of time.
Great, thanks. Bill, the next question goes to you, and that has to do with investment strategy. In your 2012 outlook, you mentioned further price pressure on top quality assets, the flight to quality continuing on, as we've seen in the last 18 months, well into 2012. One of the audience members asked a question, how do you balance the flight to safety with the higher yields that can now be obtained in the maybe higher risk assets or secondary markets? Is it time to make that move, or are there still too many economic concerns and other concerns that would make you recommend against it in 2012?
I think the current market, and I don't know how long this is going to last as I comment about the pension funds, these guys have a lot of capital to deploy. And until their portfolios are balanced, they're going to be winning deals in these core markets. That's what's been giving these 5.5, sub-5 cap rates in a lot of different food groups. In Southern California, 4 deals of late, all grocery-based product is traded in the 5.5 to the 5 range. We're in contract now with a deal currently, European pension fund. Is if we start looking across these major markets, East Coast is seeing the same thing. Connecticut, the tri-state area, big appetite for that. When that balances out, then we're going to see another opportunity to pursue in these markets. So if I'm investing today, I'm going to look for yield opportunities, perhaps in the midsection. And what I'm going to focus on are those shopping centers that have good historic fundamentals. Maybe my anchor grocer has been there for 15 years. The lease is coming due, so it's not getting that favorable of a going-in cap rate. But I look at his sales, I look at where he's located, and I say, you know what, that trend's going to continue. So always focus on the historic occupancy cost and fundamentals of the shopping center, and I think that's where you're going to find good opportunity.
A follow-on question in the same vein, and that is a question from an investor that writes, what will come of the high vacancy newer centers that were built in outlying areas because of rooftops that were going up, which are now not seeing the backfill demand? What's your outlook for that product?
Right. So retail has always followed rooftops, and we did get a little ahead of ourselves in certain markets. In these places where large vacancies are occurring, and when I say large, 10,000 square feet or greater, there's been some real creativity amongst the landlords out there. I've seen healthcare, a big movement there, whether it's the local hospital opens up an urgent care clinic, that type of thing. That is really filling up a lot of that space. The docs, the chiropractors, the dentists, et cetera, they're moving into these spaces. It's a lower cost alternative than a mid-rise office. But that's going to be interim. And as these markets catch up, as the housing bubble, or I shouldn't say the bubble, the overhang clears, yeah, that space is going to capture, because every day we have necessity-based needs, right? We got to eat, we need some clothes, got to get to the dry cleaners, all of those things. That'll backfill over time.
Great. The next question is actually addressed to me, and I'd love your comment too, in that one of the investors asked the question, what will it take for the economy to get back to more exciting levels of growth? What do we have to see before that can occur, and how realistic is it that it'll occur in 2012? And I'll take a shot at that, and love for you both to weigh in on that question. And the most important thing is the removal of fear. I mean, to the extent that what Europe is attempting to do in coming up with a systemic problem to their debt, as we've seen, it's facing lots of headwinds and issues, whether it's Greece having to take action in terms of their government composition, whether it's problems in Italy, and so on. It's hard to tell whether this will basically work just yet. But at least they're moving in the right direction. Assuming that there's progress there, and that fear factor gets reduced, and we get through the elections, I think a lot of the uncertainty out there has to do with taxation, has to do with healthcare costs and so on, and companies are still very conservative. The good news is that, as I mentioned, they didn't panic and go into layoff mode. They're still hiring at a very modest level. But if those two major clouds break over the next 12 months, the stronger footing that I talked about earlier and the natural momentum of the economy to grow, I think, will carry us into much more respectable numbers. Instead of 2.5% GDP growth, we could see 3.5%, which is more like a recovery. So how likely is it happening in 2012? I'm optimistic that it'll be progress in 2012, but I don't think the logjam is going to break next year. I think it's going to be well into 2013 before we see those kinds of numbers come up. Anything to add to that?
The one thing I'm going to comment, and it's the old adage, when your neighbor loses his job, it's a recession, and when you lose your job, it's a depression. Right. And I think it's all consumer based. I believe in the consumer and the strength of the consumer, and I think the consumer, as you so aptly said, has to regain confidence. There's just been so much negative information, whether it be our deficit and lack of ability to extend deficit, whether it be Europe, which, quite frankly, I'm not sure that plays too big in the mindset of the investor, or the consumer. It does certainly with our markets, sure, but it doesn't impact the U.S. consumer. So I think it's just that. I think we need to create solid job growth. I think once we see some job growth come back, and quite frankly, I think we're better off with consistent, sustained job growth than these ebbs and flows. I think that causes a lot of uncertainty in the marketplace.
Hessam, you said earlier 70% of GDP is consumption. And our retail numbers that posted third quarter, guess what? They're up. And if you looked at the trough in your chart, it shows back at the bottom of the great recession that we showed, and now we're climbing at 6% above. So that's indicating to me that consumption's there, it's healthy, it's moving forward. If you're an investor in commercial real estate, retail real estate, you at least feel like, good, I entered this market here on the bottom. So where are things going to go? They're going to continue to grow in a steady path. It is jobs. We've all talked about that. Part of that jobs, construction. We've got this stall in retail development. I don't know where we are in housing or other markets, but stall. I think, yeah, so as construction jobs kick in, that's going to start spiking the numbers.
Great. For those of you that submitted questions that we didn't get to, we will respond by email, and thank you very much for submitting questions. And with that, I'm going to turn it over to Bill for closing comments.
Thank you very much. We so enjoyed this. Hope this is of good value to you as well. We'll see you in 2012 for our update from our comments this week. And until then, have a good Thanksgiving.